speaking with Jeff Kingsley, partner at the law firm of Goldberg and Segalla, and he specializes in cyber liability issues. But also, I'd like to ask you, Jeff, just to start off, you were speaking earlier about the implications of something like Superstorm Sandy. Can you tell us a little bit about that? Because I know you probably went through most of it.
Well, absolutely. We were in the issues with Superstorm Sandy, along with a lot of other large-scale environmental catastrophes, particularly in the States. What we've seen as being involved as National Coverage Counsel for a number of carriers is the injection of regulatory oversight that was unpredicted. It was not able to be seen or foreseen before you place it. So if you place a policy or a premium with respect to a certain level of cover for, say, Lower Manhattan or New Jersey or Staten Island, you think that certain areas in terms of the regulations that are currently in place would hold and take effect. So your claims handling processes, the costs associated with the claims handling processes will remain intact and consistent throughout the process. What Superstorm Sandy has shown us is that, and it's not atypical, but it's a reflection and an education for the insurance industry on a going forward basis, given that these climate-related or climate-changing large-scale environmental catastrophes are occurring on a more frequent basis, to which the modeling for the insurance industry is changing and catching up to it. But as these occur more frequently, we need to understand and appreciate that regulations and regulators work on a different set of parameters necessarily, and sometimes they inject or change the processes in which an insurance carrier handles these claims. Superstorm Sandy is the perfect example of that. It had a large-scale damage, but wasn't classified as a hurricane necessarily. But what the insurance industries did in each of the states, our insurance departments of each of the states of New York, Connecticut, New Jersey, they injected a process to change the typical claims handling perspective. And what do I mean by that? I mean by that they requested or required that an insurance carrier, regardless prior to the denial of coverage, inject into a mediation process. Now you might think mediation process, it's optional, it's something along those lines, but when you're dealing with hundreds of thousands of claims, you're dealing with a claims adjuster that probably has hundreds of those, always having to go and go to these, and it's required that they would attend to go to these meetings, these mediations. There's an incentive, and perhaps that was the intent. There was incentive for this insurance carrier to compensate the insured for something that may have fallen outside of the scope of cover.
I see. And
by doing that, by injecting that process, you might think if it's a $5,000 claim for property damage, associated with that, if they pay $1,000 or $1,500 because the costs associated with going through the mediation process, the claims handling, having a mediator to ultimately determine that, it may not be worth it from a purely economic sense. But when you're dealing with the issue of insurance and risk transfer, whether it's between the insured and the insurer, or more particularly if these large scales trigger reinsurance or some type of shifting of coverage, a reinsurer will not look too kindly on an insurance company paying out these claims, what they would consider to be gratuitous payments.
And they might not want to.
They would think that they're gratuitous payments. So you put the direct insurer, the ceding insurer, if it's involved in reinsurance, in a very difficult position. Because one, you're increasing the cost associated with handling these potentially non-covered claims. There's an incentive to pay out those claims, but you won't necessarily be able to transfer that on the back end. And the insurance industry, in placing premium, getting back to the point, and understanding these things, when you're dealing with economic or environmental changes, that they need to understand that these regulatory injections for large-scale, high publicity, high areas is more of a regular aspect of it rather than an exception. You can date back to, as I indicated, you can date back to 1988. When the California hurricane or California earthquake, and the California Insurance Department, the insurance commissioner, issued changes that basically almost rewrote or arguably rewrote some of the insurance policies. So it's not unusual.
Post-event, I assume.
Post-event, retroactive, and it's not unusual for those situations. But what needs to be understood is if these are happening more frequently, this isn't something once in 20-year event. maybe it's a once in 2 year, 3 year event. And if you do that, then people who are placing it and placing premiums may have to take those considerations, the injection of regulatory oversight that may not be understood at the time, but you will have to have an added cost for large-scale claims to be added into the claims handling process, adding it into how you place premium, and thereby maybe understanding and be a little bit more proactive in maybe even terms of how you place or write the policies. Because one of the things that Superstorm Sandy, the regulators always use as an issue potentially is intent. No one intended for this large-scale thing to happen, and because the policy was really maybe arguably unclear in some aspects of it, they wanted to inject a process that made it more equitable for the insureds. So if you understand this is more of a regular occurrence as opposed to an exception, you could have better claims handling processes and protocols. You can have better policy terms and conditions and provisions that maybe address it a little bit more to mitigate or offset some of the intent issues in terms of the equity. The regulators always feel that that the reason why that they're putting themselves in that process, and so that you can handle these things on a regular scale, so it doesn't come up as I have to do this mediation. It's taking up a lot of resources, and it basically effectively alters or shuts down a portion of an insurance carrier by handling these claims. If you put those protocols in place, you can try to mitigate and be more proactive. Is it since you don't know what they will do, you can't gain certainty, but what you try to do, just like in the insurance industry as a whole, you try to get some greater degree of certainty.
Exactly. Yeah.
So,
in other words, to be more prepared for something that is more likely to happen than it used to be.
If it happens every 2 to 3 years, and you know the regulations and regulators, both in Katrina to a lesser extent, but more particularly Superstorm Sandy, because it wasn't a hurricane, didn't hit large scale, but did affect a number of people.
Sure did.
Both those instances had some regulatory modifications post-event, retroactive, and since these are occurring more on a 2 to 3 year cycle as opposed to 20-year cycles, the industry needs to be prepared for itself.
You bet it does. The other thing that I know you're specialized in, which the industry also has to prepare itself for, is cyber liability. I know we spoke last year, and it was very interesting. What kind of has developed over the past year or so in that field?
The area that I've seen the most development is in the states, particularly California taking the lead, but a number of states requiring certain privacy disclosures and protocols impacting altering the insurance carrier's perspective on how to handle these third-party cyber liability risks. Cyber liability, as opposed to cyber crimes, is a third-party versus first-party aspect of it. And you need protocols in place, but more states have taken upon themselves to issue regulations in handling and securing the privacy of third-party data. And the influx of regulations that are coming, New York's coming soon on high-end third-party cyber data and how you handle it, and more particularly how you notify the carriers and the public if it affects a certain number of people. In California, for example, the Regulation 24 just came down recently that indicated that if it affected more than 500 people, that you have an obligation to notify and trigger these type of events. 500 people may seem like a lot, but when you're dealing with it's really not that many people. So you're dealing with these regulations from a statewide perspective to handle these things. It's compelling carriers to alter it's compelling companies to alter their privacy terms and conditions, and by the very nature, forcing them more particularly to get into the cyber liability market where they were still hoping or not understanding the processes. Okay. So where we were last year was the issue of what's the difference between cyber liability as opposed to a traditional CGL policy or some type of policy, and we talked about the tangible versus the intangible. Exactly. And how those aspects took into place. The industries and most companies are aware and appreciate the distinctions. Now, when you add that dynamic of the regulators coming involved and telling them what notifications you have to do, what other securities and issues that you have to take care of when you're basically the steward of third-party data, they are now flocking more towards these type of policies, but they want to understand that these notices and the cover will address these concerns. So, for example, they don't notify someone, the 500 people or not. Then you get in a situation where what policies are in place to protect that company, that now you not only have the loss, but the notice of a potential loss with respect to that may trigger this, and it may trigger policy. So it's not necessarily the loss or the tangible loss or intangible loss. It is more of the prospects of the potential and what regulations and regulators are trying to do to have companies address those concerns.
I see. Okay, well, we're talking about cyber liability, and I know, could you just explain the idea, I know you did last year, of the sort of the shift that continues to occur between intangible property, real property or commercial property, and intangible property?
Absolutely. One can only look at your iPhone, your iPad, any type of technology. These days, instead of the tangible document that you have, it's in an iCloud. It's data. It's intangible. It's out there, that it's stored either off-site, on-site, through a server or through some sort of third-party provider. All of our data, the way in which our economy works, is moving more towards the physical property. You know, the loss of the business, the property, the physical damage. A greater and greater percentage of the potential loss is dealing with the data, the information, the protocols and procedures. No longer are they physical files stored in a company. They are placed, outsourced, or in the cyber universe in terms of how they handle it. It could come down from payroll. It could come down to personal information with respect to your clients and personal information with respect to risk. It could come down to how you handle claims. Take the insurance company. Claims, policy documents, information as to the scope of cover, what you did previously, renewals. All of that information is now in the cyber universe and is technically intangible, or could be deemed to be intangible as opposed to tangible property.
Sure.
Some of those aspects also have a tangible component. Typically you have stored data that also has maybe a physical file to it. But more and more, as we talked about last year, there's a shift away from keeping the tangible properties and allowing companies to use intangible aspects of those formerly tangible entities to be more efficient, to be quicker, to respond quicker, and to adjust to the fast-paced economy that we live in today.
Of course.
But because of that, those aspects of being intangible, if companies, as we talked last year, don't understand that your normal insurance cover may not cover losses for third-party liability exposures to those technically intangible properties. It poses a number of issues in terms of the legal challenges and the insurance challenges associated with that aspect. And I think over the past year you've seen even more companies. I think the percentage is almost getting far greater than 50%, that most of the stuff is stored via data as opposed to tangible. And it's only going to increase. So the exposure of intangible loss vis-a-vis tangible loss will continue to shift and almost get to the point where the intangible loss engulfs or oversees the tangible loss in some markets and in some industries.
Well, if you consider the phrase big data, well, big data is all stored electronically.
Exactly.
We're not talking about reams and reams of paper.
Right.
And therefore, it is at risk if somebody decides that they can find a way to get that information, which I assume that's more like cyber crime than cyber liability. But the liability attaches when somebody wrongfully uses that data, or even just gets it.
Right. Right. And most of the data now in iPads and things like that are in through clouds or through some third party, and a breach of that, intentional or otherwise, can create a huge potential loss. And the understanding in the dynamic that we see still now, and we could talk next year, and we'll probably be talking a lot of these same issues.
Probably.
Is the privacy concerns. When you have the privacy concerns and you balance them out with the need to have intangible property, and then how does a company look to have some type of cover to insulate themselves from a large-scale cyber loss? And with those dynamics, with privacy concerns, now you have the notice with regulators now catching up to this in this industry. You have the potential increasing pie in terms of intangible data, and you're talking about how do you get the policies that cover it on a year-to-year basis. You'll see the policies probably change and continue to modify pretty significantly over the next year or two.
All right. I know you've been to the reinsurance rendezvous before. What do you think of it? What do you think of the one this year? It's a lot of people, huh?
Oh, it's fantastic. I got to tell you, I look forward to it each year. It's when you deal with things on a smaller scale in terms of people in 10s, 15s, or even a conference or two, you get a certain feel for it. But when you get a large sector of the industry converging on an event for 2 to 3 days, you really get not only the flavor, but you get the real, distilled down to its essence, the concerns and issues that are associated with the industry. So it gives you an unbelievable leg up when you go back and do your practice, your respected fields, to provide that insight and analysis to your colleagues, to your clients, prospective clients, and it really provides the energy that you need to finish out the year and look into the 2014.
Yeah, it's really something.
Yeah.
Jeff, thank you so much.
Not a problem, Charlie.